So folks, in the last video, we have seen a short straddle. Now let's see a long straddle, okay? So it will be a completely invert what we have seen in the short straddle. It will be reverse of that here. So that was a credit strategy. So this one would be what? Definitely a debit strategy. So here we are going for a long at the money call and long at the money put, okay? Now question comes, what is your market outlook? So here we are looking for a significant volatility in the underlying price movement. So we are assuming that market maybe underlying price has to move sharply up or sharply down. And all the positions would be of the same series. So it is not two different series. We're not going to mix up here. Everything would be maybe of a weekly, the same weekly series or maybe same monthly series. So we are going for a long at the money put and long at the money call. So if you're going for both the things long, it means it's a debit strategy. So maximum risk would be your limited, because that would be limited to the debit that you have paid, okay? And next reward would be unlimited, because underline can go as long as a possible up it can go. There is no technically mathematically it's a unlimited infinite. Now let's see the prerequisites. So outlook, sharp price movement we expecting in the underline. I don't know whether it's going to go up or going to go down, but definitely a sharp move I'm expecting. And that to next 3-4 days, not more than that kind of thing. Okay, volatility wise, we want very low, because here net we are buying. Okay, we are buying both long calls and long put. So we are paying money from our pocket. So we want to pay a low money. That's the reason we want a current volatility to be very low. Now, if you're buying something, so typically we are doing some kind of investments. Okay, so investments are for the long terms, versus if you're selling something, typically that is a trading and that has to be a short term. So here the series would be far, if possible. If there's a liquidity issue, then come down to the next. That would be a better approach. But if there are more than 3 weeks are there in the current series, you may opt for it. Spot price wise, we want it to be at the middle of the range. Current, especially if there is a descending kind of a triangle is there and price gonna, we know now it's currently at the center and it may burst on the upper side or lower side. We would prefer to go for a long straddle, okay? And let's see the example. So market is 17,500. So we're gonna go a long put 17,500 and we're gonna go a long call 17,500. If you ask me any insurance, there is nothing kind of insurance here, and everything is my source of income here. If you see a payoff here, T plus 0 is very important over here. So if we're taking this trade in next T plus 0 or T plus 1 or T plus 2 or T plus 3, we are expecting a sharp move. That's the reason I'm into the long straddle. But if you take this trade and hold it for a longer duration, then other theta would have a negative impact on our positions. And let's see break evens on the expiry day. So as you can see, those are our upper break evens and lower break evens. Currently we are at the center of that. So this is a long put and long call. So the bold line is for the expiry and the dotted line is for T plus 0. Now here we're going to see the example. So although I've took this example on 2nd of Feb and when the volatility was very high, definitely this is not the right example, but let's see. Okay. If you see, market was at around 17,502.50, and we thought let's plan a long straddle. So we will go at the money 17,500 a long put and long call. Now in this case, we were able to sell at around 225 for the long put and to call and the long call at 324. So if you see the net debit, that is around 549. So we are paying a 549 point from our pocket. So this is a maximum loss risk in the trade. So if you take this trade and market doesn't move here and there and you're holding this trade until the expiry, then that would be your max loss, versus if you're getting out of this trade in next 2 or 3 days, that will be slightly much lower than that, okay? Maximum profit potential is unlimited. As you can see, it's showing us infinite over here. So that's the reason it's showing that your maximum profit potential is unlimited. Typically for long call is unlimited, short call is limited to the underline can go up to the zero, it cannot go below zero. Okay, that is the assumption. And break evens calculation, so you have to consider the spot price, that is 70,500, add the money 70,500, and then add and subtract your total debit, and that would give us upper break even and lower break even. So if you subtract, that will give you lower break even, that is a 6950, and if you add, that will give you the upper break even, and that will be 18,049.20. Okay, now this is a payoff for 70,500 a long straddle. So here my focus would be more on T plus 0 line rather than the expiry line, because I'm not expecting to hold this trade until the expiry. Next one is a summary. So here we're going to talk about the Greeks. So the most important Greeks are delta here. So here delta, we are expecting a volatile movement on the underline. So that is, a delta is very important for us. The higher the delta is better for this trade. Vega wise, you can see it's showing us positive. So it means a Vega increases, that will have a positive impact. So we want Vega to rise. Now question comes, when Vega will increase, provided it is currently low. So we want to take this trade when volatility is very low. That would be right situation, and then take this trade. So you're going to earn from delta also if price movement is there, plus it's going to support the Vega. Versus theta is the only enemy over here. So if you hold this trade for a longer duration, it's going to have a negative impact. And gamma is positive, but that impact we're going to see only on the last few days of the expiry, and we are not expecting to hold this trade until the expiry. And that is all for a long straddle. And in the next video, we're going to see R and condor. Yeah, so welcome once again, and in this video we're going to talk about short straddle. So earlier we talked about the triangle that was out of the money. Now we are coming at the money, and that is what short triangle here. So it is similar to your short triangle. So basically here it is a credit strategy. So net we are a seller. Okay, and then your outlook is non-directional. So we are assuming market be in a range bound kind of thing, so sideways, and we are selling at the money call and at the money put, and everything would be of the same series. As we are shorting both at the money call and at the money put. My risk in this trade is unlimited, and reward of course for any selling is limited. Okay, so here let's see prerequisites. So one, out in terms of outlook, it is a sideways, so we expecting market to be a range bound. In terms of volatility, so we're going to take this strategy when my volatility is very high. For example, if you're talking in terms of IVP percentile, so if it is above 80, you can go ahead and take a short straddle. Expiry wise, we want a near series. So near series is much better because we're going to get a benefit of theta. And if a near series is too near, you may go for a next series, but avoid a far series. Spot price, definitely we want in a middle of the range. So middle of the range means there is a support, there is resistance. We want price to be at the center. That would be a most ideal situation, but it can be taken slightly plus or minus. So let's see the structure of this one. So we're gonna short a put, that is at the money, and then we're gonna short a call, and that is again at the money. So here in this particular example, when market was say around 70,500, so we're gonna short a call of 70,500 call, and we're gonna short 17,500 put. So we're gonna see a payoff for short straddle. So we're going to short at the money, so it will be kind of an invert V. Okay, so this is what your short put and short call, and you're going to receive some credit, and because of that you're going to have some profit potential, and then there would be a lower protections and the upper protections, or a lot of guys may call it lower break evens and the upper break evens. Let's see with the numbers here. So we took these numbers on Feb 2nd when volatility was very high, and that is really good for a short straddle. So at that time, market was at around 70,500, and to be precise, as you can see over here. And let's see the price of call and put. So short put was trading at around 225 and the short call was at around 324. Okay, so if you combine both 225 plus around 324, it comes to around nearby around 549 or to be roughly a 550. So maximum profit potential in this strategy is 549. And if you see the upper protection, so that would be you have to subtract from at the money. So 70,500 minus 549, so that would be 16,950. So that will be your lower protections or lower break-evens. And if you add the credit to the 70,500, that would come to 18,049, and that will be your upper break-even. So this is the way to calculate your break-evens for straddle. Now we're gonna go and see the payoff. So this is today's payoff. So you can see that today's payoff is kind of a curve, and we will not have enough profit over here. Versus if market stays in the trade for some time, or maybe if volatility reduces today itself, then we're going to have really good profit here. And the more you stay in the trade, you will have more profit over here. But the only catch is that profit would be at a single point. For example, in this case, if underlying expires at 70,500, then you're going to have a max profit potential. Otherwise, your profit potential will be slightly here and there. So every different strikes would have a different profit potential over here. So if you're very sure that market going to expire at certain levels, then I would recommend you to go for a short straddle. But if you think that market you want to be slightly flexible, then go for a short strangle. Now let's see in terms of Greeks. So if you can see that delta is here negative. So we do want market to move sharply up and sharply down, because if market goes up, we're going to lose something. Market goes down sharply, you're going to lose. So we want delta as low as possible over here. In terms of Vega is showing us negative. So we want volatility to reduce. Now volatility will reduce provided that currently volatility is at very high. Then only there would be some option to go down. So you have to take this trade when your Vega or volatility is very high, and there would be some scope to come down, especially that happens during the earnings seasons or elections or budget or some big announcements. Okay, and then theta wise we can see in the green color over here, and that shows that theta is around 12.82. It means today if I stay in this trade, I'm going to earn around 12.8 points. And the more we stay, the theta would increase further and it would be higher than that value. Versus gamma is negative. So gamma is very problematic for short straddles. We normally avoid to be in this trade, especially last hour of a expiry day or maybe last day on the expiry day. And this is a adjustment plan. So assume that we took a short straddle, and we were assuming that market would be a range bound, but then market started going up sharply, going down sharply. So assume that market has reached your upper break even. So here we are assuming that market is going up very sharply and is currently at the upper break even. So you have the option here that you can roll that short put 70,500 to maybe 70,600. So in that case, your payoff would change. So initially it was a short straddle, but you kept a call as it is and you moved a put slightly higher. Okay, so if you see the new payoff, that would be like a strangle. So if I only show you the payoff, you will be confused. You won't say that whether this is a short strangle or it is after the adjustment of a short straddle. Okay, so both the payoff would be exactly same, but the only difference is that in this particular case, your call would be on the left hand side and put is on the right hand side, because call stayed there and put moved ahead of that. So in normal strangle, your put is on the left hand side and call is on right hand side. Okay, so but here what happened, call stayed here and this put moved further ahead, and that's the reason this would become a invert short strangle. So that is all about a short straddle. In the next video we're going to talk reverse of that, and that would be a long straddle. So guys, we're going to start our first strategy, that is a short strangle. Okay, as the name says, short means what? We are selling something, so it is a credit strategy. Okay, so here net it will be we're going to receive some money. So that's the reason this is called a credit strategy. It is used for a non-direction. Okay, so assume that you have a view that market would be between so and so levels. In that case, this would be the best strategy. And here we're going to short out of the money option. So what happens here, we're going to short out of the money a call and out of the money put, and then we're going to assume that those two strikes where we have sold, market's going to stay between those strikes. Okay, here whatever we are going to sell, that would be of the same series. So for example, if I'm selling for the January series a call, then I'm going to sell a January series put also. So I'm not going to mix up two different series here. So here basically we are selling out of the money calls and out of the money puts, as we are shorting here. So risk would be unlimited, because technically if you're short a call, that would be undefined risk would be there. And for short put, if you go mathematically, it will go below zero. I mean, it can go up to zero, but recently we have seen that market can go even below zero. So the risk over here is unlimited versus reward is here limited. Okay, so this is the nature of the strategy. And next question comes, hey, what should be my outlook? So outlook should be sideways. As I'm saying, market gonna stay maybe 2% up, 2% down throughout the end of the series. And next, the biggest question is when to initiate this strategy. So when my volatility of the market is very high. For example, like India VIX is very high at the time of budget, or maybe at the time of general election. So whenever, or maybe during the earnings season. So whenever you say that volatility of the underlying is either high or very high, in terms of IVP, you may say anything above 60 or above 80. Okay, so those things you may assume, or maybe if you have some other ways to calculate, you can calculate that. And if it shows that volatility is very high or high, then go and initiate your short strangle. Next bigger question is about the series. Should I go for the current series? Should I go for the near series, next series, or far series? So the answer is go for the near series as near as possible, because we want to take a benefit of theta also here. And underline wise, the price, if it is at the middle of the range means support is over here and resistance is over there. Okay, so we want if price is most likely at the middle of those range, that would be most ideal time to initiate this strategy, so that market could stay, it may go slightly up, slightly down, but at the end it should end in between both the strikes. And if you see, we typically call it a minus P and minus C. Minus P means short put and minus C means a shorter call. And let's assume that our underline is Nifty here, and currently Nifty is trading at around 17,500. Okay, so that is what level we are assuming. And my assumption is that next until the expiry, or maybe market would stay between 17,200 to 17,800. So we are giving 300 points up and 300 points below room, and we are assuming that market is going to stay between this. So total room is of 600 points. And in that case, I'm going to short a 17,800 call, and then I'm going to short 17,200 put. Okay, so that's 300 points up and 300 points down. So 17,200 put and 17,800 call. We're going to short that, and that would become your short strangle. If you see the payoff diagram, that will be something like we are shorted here, undefined risk, both the sides would be there. So on the first left hand side, it will be a short put, and on the right hand side, it will be a short call. And then there would be some kind of a break-even lines. Okay, so once you short, you're going to get some credit, and if you add or minus that credit with respect to the underlying strike rate and the price, you're going to get some low protection, upper protection. A few of the tools may call it break-evens. So that will be like upper break-evens and lower break-evens would be there. And then there would be a payoff for the today, that is T plus 0, and then there would be a payoff for expiry. So on the expiry, it will be like this, versus for the today, it would be like a curve would be there. Let's take the example here. Taking this trade when Nifty was at around 7,500. So we are giving a 300 point safety on the upper side and 300 point safety on the lower side. So we're going to short a 70,800 call and 70,200 put. Okay. If you see the price over here, we are able to see that the price for the short put was 129 and short call was 170. So if you add 129 plus 170, so that comes to 299. So roughly assume it's a 300 bucks. Okay, So 299 to be precise, but it's roughly 300 bucks. Now let's see how do we calculate the break even. So we have sold 17,800, so add a 300 to that, so that would become 18,100. So roughly 18,100 would be your break even on the upper side, and if you subtract a same 299 or 300 from the 17,200 put, that would come down to 16,900 or 901 to be precise. So that would be your break even points, or we call it upper production, lower productions, or upper break even and lower break evens. Okay, and if you see Greeks wise, those informations are written over here. So we can see that total delta is slightly negative, okay, because market was at around 17,502, and we took this trade at 470, slightly, I mean, out of the price was slightly higher. So precisely we were assuming 17,500. Okay, so it's showing that slightly negative data is there, versus Vega is showing us minus 30. It means if Vega increases, we're going to lose around 30 points, versus if Vega reduces, it's going to earn we're going to earn around 30 points. And theta, as you can see in the green color, it means that our theta is positive. So today we're going to earn around 11.59 points, and as the day increases, we're going to earn more. Okay, and gamma wise is showing a slightly negative as of now, because expiry is far away. We're going to see a gamma impact only during the expiry day. Okay, now this is your payoff diagram. So here we can see that is T plus 0 payoff, versus this is a payoff on your expiry day. And let me see a total strategy summary. So the way I've explained you earlier, the maximum profit potential is 299, versus upper production is 18,099. That's my upper break even, and lower break even is 16,901. And here we can see that we have a room of around 3.41% safety on the upper side, versus we have a room of around 3.44 on the lower side. And the Greeks, the way I've explained you, is showing you over here. Now, next important question is that we took this trade, and say market is showing some erratic movement. We were assuming market to be a non-directional, but now market is turning into a directional. So let's take the example that market moved up, okay, and it moved up, or maybe it even crossed our break evens, okay, upper break evens. Then what would be typical adjustments over here? So first, if market is going up, then we have to move up. So the most easiest adjustment would be short put would be in profit. So we're going to close that short put, and we're going to move slightly up. So we have shorted a put of around 17,200. We may move up to 70,300 or 70,400 or 500 based on how soon market goes over there. We can take that decision. And inversely, if market goes down, in that case, we have to roll down the short call. Okay, so if market is going up, roll up the short put, and if market is going down, roll down the short call. So this is a very simple adjustments, and you can roll a short put up, and it may happen that initially you took the short strangle and market just you're moving up one side up, or you're moving one side down, and it can become a straddle strategy. So guys, with that we have completed a short strangle, and in the next video we're gonna see the reverse of that. That would be a long strangle. So welcome back, and in this video we're gonna see a long strangle. So earlier video we noticed a short strangle, so inverse of that is a long strangle. So here the earlier strategy was a credit strategy, so this one is a debit strategy. So we're gonna do a long strangle. So net have to pay money, so that's the reason this is called a debit strategy. Now next question comes, hey, what should be my market outlook? Should I take it when I'm a non-directional? Should I take it when I'm a direction like bullish or bearish? So technically here, if you're expecting some kind of a sharp move, either upside or downside. So I don't know whether it's going to be a very upside move or downside move, but I'm expecting really a big, maybe a 5%, 10% kind of a move in a day, maybe because there is some announcement is there, there's a budget today, or maybe election results are there, and you're expecting a significantly upside or downside move. In that case, you can go for the long strangle. But only the challenge is that this strategy should be taken when the volatility is very low. Okay, because here we are net a buyer. So if you're doing this kind of strategy on a very high volatility, so you're going to pay a very huge premium, and then the break evens will be far away. So the first important thing, this is debit strategies. You are expecting a very sharp move on the upper side or on the downside, and the volatility is very low. Here all the series are of the all the legs of are of the same series. So all the legs are of the same series. So we're going to go out of the money a long call and out of the money long put, as this is a debit strategy. So the maximum risk would be limited versus your reward would be unlimited. Okay. So let's again see what are the prerequisites here. So first is outlook. We're expecting a sharp move in the underline. And that too a sharp move in a very short span of time. I'm not expecting that it's going to take a 10 days or 20 days. I'm just expecting maybe next 2 or 3 days there would be a sharp move on the upper side or sharp move on the lower side. Volatility has to be low. So if you're talking about in terms of IVR or IVP, and let to be precise IVP, then it would be a below 20 or below 40 kind of thing. And next about the series. So I would preferably I will go for the fast series. If there is a liquidity issue, I would love to come to the next series. But near series, if it is more than 3 weeks are there, you may consider that. But if hardly a week is there, then I would say avoid that. Okay. And the spot price to be at the middle of the range. Okay, so currently we are assuming there is a support and resistance, and currently we are at the middle, so that if market moves, it can at least go and hit your resistance or hit your support level. Okay, and here if you see the structure wise, it's a long call and long put, so that is a plus P and plus C. So let's assume that currently the spot price for the Nifty is at around 17,500, and we're expecting that market can move sharply up and sharply down. So we are just taking the inverse example of the earlier when we did a short strangle. So here we are going along 17,200 and we are going long call 17,800. So long put 17,200 and long call 17,800. The best thing you have to do have to go for a fast series, or maybe come down to the next series. But in this example, because there is a more than 3 weeks are there, we went for the Feb series. Okay, so this would be a typical diagram would be there. So here if you see the T plus 0, that's very important for us, because here the guys are taking a trade for T plus 0, T plus 1 or T plus 2 kind of things. They are not waiting for the expiry. The more you stay in this trade for longer duration, theta would be against you. So basically I'm taking this trade in expectation that in next 2 or 3 days there would be a sharp rise, maybe on the upper side, or maybe a sharp decline on the lower side, and then I'm going to get out of this trade. So here if you're expecting let's see a payoff on the expiry day. So here we went for the long put and we went for the long call. This would be known as our upper break evens, and this would be known as a lower break even. This dotted line is T plus 0 line, so this is important. So either T plus 0, T plus 1 or T plus 2 or T plus 3. This is the maximum 3 or 4 days we're going to hold this trade, and I'm gonna come out of this trade. Now here if you see the payoff diagram, it may not be lucrative here because we took this data on February 2nd when just after a budget, and the volatility was very high and the premiums were super high. So that's the reason it's showing us more debits. Otherwise normally if volatility is very low, then your debit would be very small, and in that case this would be really good option to go for. Now, if in this particular example, if you see, we went for a long put 17,200, we went for a long call 17,800, and if you see maximum profit potential is showing us infinite. So technically, if market goes maybe 5%, 10%, 20% up, it would be at infinite profit potential is there. Versus if you see a maximum loss risk or how much you're going to lose, it is a total debit. So the total debit is 299. So I'm going to lose 299. Now question comes, how does it came 299? Because we paid 129 for the long put and we have paid 170 for the long call. So if you add 170 plus 129, that would be 299. So in this strategy, the maximum points you're going to lose is 299. Versus if you see the upper break evens, so this strike 7,200 plus minus 299, so that will be 16,901. Versus if you see the upper side break even, then it would be 17,800 plus your total credit, that's a 299 total debit, and that would come down, that would become 18,099. So that is our break evens for this trade. It means if you're expecting the market to go more than 3.4 before the expiry, then go ahead this trade. Okay, so we need a really sharp move. If your market stays between this range, then this would end in a loss. Okay, so here we're expecting a really sharp move, and that too in next 3 days maximum, and we would be getting out of this trade. Now let's talk about payoff here. So this is again t plus 0, and that is your expiry. So in case of a debit strategy, it's better to come out of the trade as early as possible, versus if you're trading a credit strategy, the more you stay in the trade, mostly your theta would be in your favor. Now let's talk about in terms of delta. So here we can see the delta is 0.04. So if market goes up, I'm going to earn, if market rises by 1 point, I'm going to earn 0.04 points. In that case, I want market to move sharply up or sharply down. So that would be really, really beneficial here. If you see Vega, it would showing us a 30. So here Vega increases, we're going to earn 30 points. So you have to take this strategy when Vega is or volatility is very, very low, so that there is some scope to increase. The more Vega increases, that would be beneficial. So if you're taking this trade, especially on some kind of a very high volatility day, for example, like budget day, election day, then it may not give you really good results. Versus if you're taking this trade when some ascending triangles or descending triangle comes and it merges over there, and then you're expecting either this upper side move or lower side move, those kind of time when the volatility is also very low, this would be really good lucrative option. And if you say theta, it's showing us in the red color, that is minus 11. So the more you stay in the trade, you're going to lose from the theta. Gamma wise is a positive. So if a market gamma increases, but normally gamma would increase on during the expiry, then this would be a good positive impact on our trade. So that is all about the long strangle. So we have covered earlier in the earlier video short straddle, and this one is a long strangle. So with that, we're gonna close this video, and next video we're gonna talk about straddle. So welcome folks, welcome back once again, and we're gonna start with the iron condor, and we will start with the short iron condor. As the name says, short iron condor. Short means what? Selling. So we're gonna sell something, and then that will become a credit strategy. So this is a credit strategy where we'll sell something, and for a safety thing, we're gonna buy the insurance. So it is a short triangle at the center, and then you buy the insurance. So we're gonna short a call and short a put, and then we go further out of the money. We're gonna buy insurance for the call, further out of the money for the put, and buy the insurance. So this is a short triangle plus insurance on both the side. Okay, and this strategy is good for the non-direction outlook, and all the positions are of the same series. Okay, and as it is a short triangle, it means a limited profit, but we have the insurance. So because of this insurance, my risk, which earlier was a unlimited, is now limited. Okay, so here let's see the prerequisites for this strategy. First, my outlook. So I'm gonna say market gonna be a range bound or sideways. Okay, so that is first a prerequisite to initiate the strategy. Second, I want a volatility to be high or very high. Okay, so whenever the volatility of Vega is very high, then this is the best strategy. Again, the example is like when the earning seasons are there, some big announcements are there, RBI announcements are there, or some other central banks announcement, when volatility or IVR or IVP is very, very high, or even HV versus IV, whatever way you do the calculation, if you think that volatility is very high, then go and take this trade. Expiry wise, we want near, because we want to take a benefit of theta. Okay, so we want to take a series which is either near or next, but not far. Next comes where should be my spot price, preferably at the within the range, or maybe at the center of the range would be most ideal time to initiate this trade. So let's see total positions. So there would be 4 positions would be here. So first 2 shorts are the main source of income. Okay, so from there we want to earn. So short OTM put and short OTM calls are my earning members, and then a long DOTM. DOTM means deep OTM, maybe a further cheap. So whatever you sold, it should be cheaper than that. So those would be my insurance. So deep OTM put and deep OTM call, we will go for long, and the purpose is insurance. Okay, so it's a plus P minus C, and then again plus C. That will be typically your structure for this short iron condor. Let's talk about the payoff. So here we have a shorted out of the money call. So as you can see here, we have shorted out of money call, that's minus C, and then minus P. Then we're going to have a lower protections and upper protection. So that will be based on the total credit that you have received, and then there would be a long put and long call. So, and just note down, this is your T plus 0 line, and this is your bold one is your expiry day payoff. So more you stay in the trade and market remains sideways, you're gonna earn more. And initially there would be not enough profit. On occasion it may come if volatility drops very fast. Okay. Example wise, let's assume that Nifty is currently trading at 7,502. So this is the price that is it showing. So short put 7,200 and short call 7,800. So market is at the center. We are taking a 300 points buffer here and another 300 points buffer on the other side. So we are selling a put 70,200 and we are selling a call 70,800. Then another 400 points we took the buffer. So here a long put is of 16,800 and long call is of 18,200. So this is our structure. Okay, so short calls, short put and long call and long put. So now let's say the price. So what we sold is 129 and 170. So the total credit here is 229, and then long put we sold at we bought at 59, and long call we bought at 54. So if you combine everything, so in earlier shorts both plus and both longs, take a sum and subtract, that will give you 184. So that is a maximum credit you have received. So let's see again, 120 plus 170 minus 59 minus 54, that is approximately 184. So maximum profit potential in this strategy is 184 versus max you can lose here is 215. Okay, so that is what so here there is nothing unlimited here. So even profit potential is limited and your maximum loss risk is also limited. Upper protection you can see based on your total credit what you have received and the strikes, it is showing us that 17,808 984, that is your upper protection or maybe upper break evens, and your lower protection is 17,015. So if you do the calculation here, you have to go and take 70,200. This is the strike you have sold and subtract this credit. So 184 you are gonna subtract that, and that's gonna give you 17,015. So this is your upper protection. If you want to calculate, that is your lower protection, and in case you want to calculate upper protection, then take the upper strike, that is 17,800 call that we have shorted, and add a 184. Okay, so that is a 17,984. So this is the way to calculate your upper protection and lower protection. So if you see a payoff for this example, so we 70,500 is the current price. We have sold 300 points away. So this would be 7,200 put we have sold, and then 70,800 call we have sold, and then another 400 points we bought the insurance for the put side, and then we have bought the insurance for the call side. Because of this two insurance, our risk in the trade is limited and your profit is also limited. Now let's talk about the Greeks here. So if you see a total data, it is showing a slightly negative. So basically we don't want market to move sharply up or sharply down. We want market to be a range bound within the range. Okay. Next, if you see a total Vega, it is showing minus 13. Okay. Basically it means if volatility increases, we're gonna lose. So basically we want volatility to reduce further. So it means my current volatility when I'm initiating this trade should be high, and later on it should degrade. Okay. So if volatility is very high, this is one of my kind of you make one of the favorite strategy where I go for a short iron condor. And if you say theta, it is a positive. It means if I stay in the trade, I'm going to earn from the time. Okay, time decay, and the more I stay in the trade, I'm going to get more a benefit of theta. Gamma is showing a slightly kind of negative. Okay, as you can see, but once you are very close to the expiry, definitely it's gonna have a bigger impact. Now let's talk about the adjustments. So if you're taking this trade, our initial assumption was that market would be a range bound. But now assume that market, instead of being a non-directional, it is converting into a directional. Okay, there's a sharp move and market has moved on the upper protection. This is just example. Okay, so market is going up. In that case, we're going to find out whether our left hand side is in profit or right hand side is profit. So technically, if you see, there are two spreads are here. So on the left hand side we can see a put spread, and on the right hand side that would be your call spread. So if market is going up, it means my left side put spread is in profit, short put would be in good profit, and long put would be in slightly loss. But if you see combine both the spread, that would be in profit. So we're gonna move this spread slightly up. Okay, so if market is moving up, just move both the spreads to a higher strikes. So in case of market is going up, move the put to the higher strikes, and if market is going down, and move the call spread to the lower strike. Okay, so just answer is, if market is going up, we have to go up, and if market is going down, we have to go down. So normally if market is going up, we move the put spread up, and if market is going down, we move the call spread down over here. This is very simple adjustments, although there are different ways, other ways are there to do the adjustment. So but we're going to focus here the one which can be easily implemented by you guys. So guys, this is all about a short iron condor, and in the next video we're going to talk about long iron condor. Thank you. So guys, in the last video we did a short iron condor. Now is the time for long iron condor. As the name says long, it means we are buying something. So this is a debit strategy. So here we are buying in the expectation that market would move one way up or one way down, but limited movement would be there. So here we will go for a long out of the money call and the long out of the money put, and the further out of the money we're gonna short. Okay, so that would be our a long iron condor. So this is just inversely a picture of your a short iron condor, and here all the legs or all the positions would be of the same series. As this is a long strategy, long calls, OTM calls and OTM puts, it means plus we are shorting. So we were going to call it two sets we are shorting and two sets we are buying. So it's a balanced strategy where our risk and reward both would be limited. Okay, so let's see what are the preconditions to take this strategy. So first of all, we're expecting that in next couple of days there would be a good movement on the upper side or on the lower side. I don't know which way, but it would be there. But definitely I'm not expecting any kind of a unlimited kind of thing. Okay, so we are expecting a sharp movement, but reasonably a sharp movement. Plus the volatility as of now is low. Okay, so it's not very low precisely, I would say. So for the very low we will go for a long straddle or long strangle, but here volatility is low, not very low. It means what price we are paying to buy, it's not very cheap, but a cheap kind of thing. So net we are buyer here, and expiry would be a far. But if there's a liquidity issue, then come down to the next series. But if you think in the currencies more than 3 weeks are there, then you can go for the current series. Okay, spot price preferably at the within the range would work, but preferably at the center would be much better. So here the main source of income, we are net as we are saying, name saying long, it means a buyer. So both the positions long OTM call and long OTM put are my main source of income versus short positions. So deep out of the money put and the deep out of the money call that we have shorted, that would act like insurance. Typically they would, as we are going for long, so there would be a theta would be against us. So those insurance would reduce that impact of a theta. So structure wise, it would be a minus P, it means a short put, then a long put, then long call, and then a short call. A payoff wise, if you see here, it will be just an inward diagram of what we have seen for the short iron condor. So we have limited losses are there and limited profit is there. And if you see T plus 0, that's again an important line for us, because if market stays within range for a longer duration of time, then theta would impact us negatively. And here is what your lower break-evens and the upper break-evens. Here this is a plus OTM calls put and the plus OTM calls. Okay, now question would be there, hey Santosh, if what's the purpose if we don't go for a short position on both the side? In that case, my reward would be unlimited. It means my long strangle would be much better than a long iron condor. So reason is that why we are going for a long iron condor, because the volatility is not very low but low. It means we are paying slightly higher price. So whatever slightly higher prices we are paying, we want to compensate that, and because of that we are going a short a dip out of the money put and the short dip out of the money call, just to compensate that money what we have paid extra. Okay, so let's see the calculation, how to calculate the break evens, so upper break evens and lower break evens. So here if you see our maximum loss is 184. Okay, so that is what maximum loss means. This is net debit we have paid, so we have to reduce that. So if you're going for a long put, that is around 7200, and reduce this debit, so that would give you a 1705. So that's your lower break even. And the same way on the upper break even, we have paid around 184 debit, so add that to a 17800, and that would give you 17984. So that's your upper break even. Now let's move forward and see the payoff with the current example. So currently the price is at 17500, as you can see here, and then we went long put at 17200, and we went a long call at 17800. And to reduce the debit, we have shorted for the out of the money calls and put. So here 16800 put we have shorted, and here we have shorted a 18200 call, and because of that our net debit has reduced. Okay, and let's talk about the Greeks. So if you see a total Greek data is showing you slightly positive, it means if there is a sharp movement up and down, data would be in our favor. Versus if you see the Vega is positive here. It means if Vega further rises, that would be positive for us. So it means currently the volatility should be a low, that will be much better. And as volatility increases from low to maybe neutral, or low to high, or low to very high, then that will give you much positive impact. And theta wise, it's negative, and here you can see -3 theta. If you remember the earlier example where we did a long strangle and a long straddle, the theta was much higher. Here theta is much lower compared to those two, because here we have done some shorting, and that is compensating the theta loss of the longs. Okay, that's the reason theta is under 4 here. But yes, if you stay here for a longer, the theta would again will have a negative impact here, and gamma would be positive, because this is a debit strategy. For debit strategies, mostly gammas are positive, versus most of the credit strategies, gamma would be negative. Okay, but that's not the thumb rule, but most of the time this would be the situation. Now let's move on to the next strategy. With that, we're going to close a long iron condor, and our next video would talk about the iron butterflies. So folks, welcome to the world of butterflies. Okay, so here we're going to start with the short iron butterfly, and then later on we would jump to the long iron butterfly. Apart from the short iron butterfly, there are other butterflies. Okay, so basically iron butterflies, sometimes we do have a call butterflies, and sometimes we do have a put butterflies. Here our objective is to cover iron butterflies, so we're going to start with the short iron butterfly. As the name says, short iron butterfly. So short means what we are selling, so it's a credit strategy. So this is a credit strategy where we are shorting at the money calls and put, and then for the out of the money we are buying calls and put. So net this is a credit strategy here. And as this is a balance strategy, because net we are shorted two calls and put, and then we went for a one total 1 year and one there. So two short positions are there and two long positions are there, so it is a balanced strategy. Balance strategy means what? My risk is limited and my reward is limited. Now, what are the preconditions to initiate this strategy? The first, most important, that my outlook is here a non-directional. So I'm expecting the market to be a range bound within a certain limits. Second, volatility, the price, because we are selling something, so we want a price to be slightly higher. So if volatility is very high, that's a good strategy. If your volatility is not very high, even for the high this will work, and even for the neutral also this would work. So all the way from very high to the neutral, this would be a best strategy to go for a short iron butterflies. In terms of expiries, as we are selling, so selling means we are doing some trading, the near trading. So it means the near series would be much better. But if you want to go, you can go for a next series, but avoid a far series. Spot price wise, if it is in the middle of the range, that would be much better. But anywhere within the range would be okay. But the preferred location is at the center. So now let's talk about the structure of the iron butterfly. So we have a total four positions are there. At the center, we have two short positions are there, and then we have two long positions. So both the short positions we call it a body of the butterfly, and both the longs we call it a wings. Okay. So we have a left wing here, we have the right wing there, and at the center we have a main body of the butterflies. So the main body we call it a main source of income. So those we are shorting and we want to earn from the shortings, and both the long positions or both the wings are for us insurance. So in case market goes up and down, it's going to just balance so that our risk would be limited. Okay, so total structure if you see, it will be insurance plus put, and then minus put, and then minus call, and then further plus call. So both would be the wings extremes, and at the center both would be a body. Now let's say the payoff, typical payoff graph. So we're going to see this kind of structure. So that's a butterfly where we have a body over here, as you can see, and those are the left wings and the right wings. So here a minus put and the minus call, and on the wing side a plus put and the plus call. Then we do have a below zero line, so that's this position would be known as a lower protections or lower break evens, and that would be upper protections or upper break even. Focus on the T plus zero line. So initially, when you take the trade, you won't have enough profit unless volatility reduces. So delta wise, we may not have a good profit, but we can earn because of vega if there's a good, it diminishes. Okay. Versus if you stay in the trade for a longer duration, then definitely you're going to earn from the theta as well as from the vega. Now let's take the example here. So again, we are assuming that Nifty is at around 7,500. In that case, we're going to short ATM, that is 7,500 call and the 500 put, and then we're going to take around 300 points safety on both the side. So I'll go with the 17,200 long put, and then we're going to go 17,800 long call. So that becomes my a butterfly kind of structure. Now let's see what are the price we are paying here. So for shorting 70,500 call and put, we are paying 225 and 224, as you can see over here. So 225 and 324. So net what we are shorting is 549. Okay, so this is what price we are shorting. And for the insurance we are paying some money. Okay, and for insurance the 16,800, the cost is around 60 bucks, and for 18,200 it is around 55 bucks. So that is our cost for the insurance. Okay, so we're going to receive around 594 because of shorts, and we have to pay. There would be debit of around 100 and some 5 rupees, or 100, yeah, roughly 105 rupees would be there. So if you do all the calculations, so first two you have to add, and both the and then subtract this and subtract this one, and that gives you around 434. So this is a net credit that you have received. So 434 is a maximum credit that you have received. So that will be your max profit potential, versus the worst case loss in this strategy is 265. Now let's talk about the break even. So how do we calculate lower protections or upper protections? So here we have a maximum credit is of around 434 rupees. Okay, so what you have to do, go on the short strike. So our short strike is 70,500 and add a 434. So that would come to 17,934. So that's our upper protection. And if you want to calculate the lower protection, so take the ATM strike and subtract the maximum profit potential or the net credit that you have received, and that gives you 17,065. So that's your upper protection and the lower protection for the strategy. Now let's see, based on this strategy, let's see the payoff. So again, we are assuming market is at 70,500 and we are shorted. T plus 0 line is kind of a flat line. So if you take this strategy and there is even a sharp movement is there, we will have a smaller losses. There won't be not big unless Vega goes against us badly. Okay, and if you stay in the trade for a longer duration and markets is the range bound, then you're going to accumulate a theta a day by day, and that would give you even more profit. So profit would come from Vega. So Vega should reduce and from the theta. Now let's talk in terms of Greeks. So if you see here, total data is close to zero. So we want data as zero as possible because this is a non-directional strategy. Versus if you're talking about Vega, in that case, it's showing a negative. It means it's a negative Vega. We want a if volatility increases, it's going to hurt us. Versus if volatility reduces, that's going to benefit us. So now question comes when volatility will reduce, provided it is currently at a very high level or high level. So if you think that volatility is a very high or even neutral, and there is some scope to reduce, then a butterfly would be a better strategy. And if you see a theta, that's a positive. It means it's a credit strategy, and as day passes, you're gonna earn from a time. And gamma, of course, is a negative because it's a uh, credit strategy here. Now let's see possible adjustments here. So we have a straddle at the center, and we have the insurance for this side. So similar adjustment what we have done in case of a straddle. Okay, so those can be applied here, but here we have to take a pair. Okay, so we have here put pair, that is a, as you can see here, a short put and the long put, and then we do have a short call and the long call. So here we are assuming that we took this trade and market started moving up sharply, and it has reached near to the upper protection at around 17,900 plus. Now it's time for the adjustment. So we're going to say, hey, is my call side is in profit or put side in a profit? So we can see net put spread is in profit versus my call spread is in the loss. So what we're going to do here, we're going to roll up here a put spread. Okay, so remove over here, we're going to move a spread, not only the short put. So along with the short put, we have to move the long put. So whatever put spreads are there, just move it to the highest strike. That would do your adjustment. So once you move short put up, you're going to receive more credit, and once you move your insurance up, that will give you some kind of a more protection if market falls down. And in that case, what happens, your upper protection would move slightly up as we have received more credit in the strategy. So this is all about possible adjustments. Although there are a lot of other complex methods are there. So once you move this spread up, what would happen here, guys? This would convert into a RN condor, but that would be a invert RN condor. Okay, so what happens in case of a normal RN condor? We have assume that we have a put this side and we have a call in this side. Here, short call is on the left hand side and short put is on the right hand side. So it has become a invert RN condo strategy. So don't go on the name, just follow the adjustments if your trade goes against you. So we want to just reduce our losses over there. So this is all about a short RN butterfly, and in the next video we're going to talk the reverse of that, and that would be a long RN butterfly. So see you there. So, welcome once again, and we're going to continue with the world of butterflies, and this time it is a long RN butterfly. So, as the name says, long means we are buying something, so it would be a debit strategy. Okay. Now, next question comes here. If it is a debit strategy and long butterflies, so what is the outlook we expecting? So we're expecting a market to give some kind of a sharp movements on the upper side, a sharp one on the lower side, but restricted. Okay. So in that case, we will go with the long RN butterfly. So at the center, we will have a long straddle, and then we're going to have a short out of the money on the left hand side and short out of money on the right hand side. That will be a put and the call. All the positions would be of the same series. So we're not mixing up different series here. As this is a balance strategy, because we have a short put and long put, then we have a short call and the long call. In that case, this becomes a balance strategy. So my risk and reward both are limited here. Okay, so this is your long RN butterfly. Let's see what are the conditions before we initiate this trade. Okay, so if you are expecting a kind of a sharp move on the left hand side or on the right hand side or on the downside on the upper side, but restricted. Okay, maybe a certain you're expecting a 3%, 5% kind of move, but you're not expecting like a really a sharp move. Okay, restricted upper side or lower side move, then you will go for the long iron butterfly. Volatility wise, we want to be done at a low. Okay, so what happens, volatility is low but not very low, so we are paying some extra premium to buy those long positions. So we are not paying a low price, but we are paying a low price. So just to whatever we're paying the extra premium, we want to reduce that debit. So to reduce that debit, we are going and shorting the out of the money puts and out of the money calls to reduce those debits. Okay, next comes what is the best series. So whenever you're buying a debit strategy, I prefer to go for a longer durations. So maybe a 4 month would be much better, but if there is a liquidity issue, come down to the next month. And if you're doing for the current series, then make sure that you have a more than 3 weeks out there to for the expiry. Now, spot price wise, within the range will do, but preferably at the center would be much better. Now, let's see what are the position wise here. Okay, so here we have at the center long straddle, that is a long ATM call and long ATM put, and those are our source of income, because from those long positions, if market moves sharply up or sharply down, we will earn a profit. So those are the main source of income, versus both the shorts, that is a long OTM put and long OTM call. Those are just to reduce the extra debits what we have given, because the price is at a low level and not at a very low level. Okay, so those who you may call it kind of an insurance, but insurance for kind of a vega wise, we have paid some extra money, so just to reduce that vega, and bit of a whenever market stays in the trade, and so we're going to get theta impact, it's going to reduce that also. Okay, so structure wise, it will be a long put, that is insurance, then sorry, short put, that's insurance, and long call, main source of income, then again a long put, main source of income, and then a long put over there. So we have both the shorts here and both the longs over there. So let's talk about the positions in this strategy. So in this strategy, we have both the longs are there. So those we call it as straddles. So straddle, long call and long put, but at the money. So those are my main source of the income. And further out of the monies, we have went for the short OTM call and short OTM puts. Those are to reduce the debit, because volatility is at low level and we are initiating this trade. Okay, so we are paying some extra premium over there. So just to reduce that extra debit, we are shorting both out of the money. So both the long positions are the main source of incomes, and both the short positions are just to reduce the debit here. So structure wise, we have a minus P. It means that's insurance, then plus P, that's our long position, then plus call, that's a long position, and then minus call, that is a short position. In terms of payoff, it will the reverse of your short iron butterfly. So the structure would be something like this. So if there is a sharp movement on the upper side or lower side, we're going to earn money, but restricted one. Okay, and if you stay in the trade for a longer duration, you will have a negative theta impact would be there. So here we can see lower break-evens on the left hand side, and then we can see a upper break-even on the right hand side. At the center, both are the long positions, so that is a, you may call it a body of this butterfly, and those are the wings on the left hand side, on the right hand side. Expiry day, we can see that if you stay more in the expiry and market stays a range bound, then you would turn into a loss, versus T plus 0 if you get a sharp movement, but a really good sharp movement is required to earn reasonable money in this trade. Now we will going to see the example over here. So assume that market is at 17,500. In that case, we will go a long straddle. That means we go at the money long call and long put. It means a long call 70,500 and long put 7,500. And then for the out of the money, say assume 300 points here and 300 points there. Then long put, that would be 17,200. We will 17,200 put. We're going to short, and then here short call 70,800. So at the center is 500, and then 300 points safety there and 300 points safety over there. You may just assume width of this wings. Okay. Now let's see a price wise. So this is example here where we can see that to go long we have paid 225 for the put and we have paid 324 for the call. So if you sum of both these things, that would come around 500 and around 49. So that is what you have paid to just buy. Now 549 is extra money, that more money that we have paid. We want to reduce that. So for that purpose, we went ahead and we have shorted a out of the money put and the call, that is 16,800 and 18,200, and that has given us a credit of around 104 rupees, as we can 111, sorry, 114 rupees credit we have received from there. And if you add this 225 plus 324 minus 59 and minus 54, that would give you approximately 434. So initially, if you see, my debit was much higher, more than 500. That was around 549 versus now it is a 434. So because of those short positions, debit has reduced for more than 400 500. It has come down to around 434, and this is the net debit that you have paid. So that would be your worst case loss. So in case market stays at the center, it doesn't move here and you're not squaring off your position, this is the worst you can lose in this trade. Versus maximum profit potential is 265. Now you're gonna ask, Santosh, it doesn't look really good trade because we took the price on the Feb 2 and the volatility was very high, and because volatility was very high, this strategy is not good for the high volatility. Had it been a low volatility, it would have shown you really a good maximum profit potential versus your maximum loss risk would have reduced further. Now let's see how do we calculate upper break-evens and the lower break-evens. So if you see debit, we have paid 434. So the focus on that 434, and then see at the money strike. So at the money strike is 17,500. And if you add 434, that would come to 70,934. So that would become your upper break-even. To calculate the lower break-even, again go back to your at the money strike, that is 70,500, and then subtract a 434 from that, and that would be approximately 17,065. So that is your lower break-even. So this is a formula to calculate your break-evens. Now this is a payoff with the current examples. So at 70,500 we went for the long. So that's the body of your long butterfly versus your upper wing and the lower wing. Okay. Now we will see what's the behavior in terms of in terms of Greeks. Okay, so we will start with the delta. So delta, you can see, is a positive delta. It means if market moves up and moves down, we will have a positive impact. Versus if market stays at the current price, then there would we will gonna lose. Okay, so we want a price to move reasonably up or reasonably down here. Now in terms of Vega, we can see it's a positive. It means if Vega increases, that will have a positive impact. So here we want Vega to increase. So we want Vega to be very low when initiating the trade. And once we took the trade, we want a Vega to rise. In that case, this would give you a really good returns. Okay. And then theta wise negative, because this is a net it's a debit strategy. The more we stay in the trade, theta would impact us negatively. So here we want we're going to earn from the delta if there's a really good reasonable moment in the price. We're going to earn Vega if Vega rises, increases very fast, and overall the theta would be negative. So you want to get out of the trade as early as possible. And gamma wise, it's showing us a kind of a positive. So if there is a gamma increase for whatever reason, that would be good for our trade. So now we will move to the next strategy, and that would be a bull call spread. So with that, we have completed till now strangles, and then we have completed straddles, and we moved to the condors, and in the last videos we covered a butterfly. So now we will move to the world of directional strategies. Okay, so bullish strategies and some bearish strategies. See you over there. Okay, folks, welcome back. And this time we will start next vertical spread in our list, and that is a bull put spread. Okay, so it's a bull means what? Bullish. Okay, so outlook is bullish, and put spread means what? we are we were going to have a two puts. One would be a short put and the other would be a long put. It's a bullish strategy. And then put is kind of if you see a put normally shows kind of negative things. Okay, so here this is a credit strategy, guys. So this is what, so we're gonna short a put and then we're gonna have a long put, because shorting a put is kind of a bullish structure. Okay, so it's a bull put spread. It means it's a vertical spread and it is a credit strategy. All my positions, or you may call it legs, are of the same series. Okay, so here the expensive thing is we are shorting ATM or OTM put, and then we are buying a cheaper insurance that will be a long OTM or deep OTM put. Okay, so the expensive would be the short position and the cheap position would be insurance in this strategy. This is a 1-to-1 ratio and a vertical spread. It means it is a balanced strategy. So my risk and reward both are limited. Now we will see what are the prerequisites to take this strategy. So the first, the necessary condition is that market outlook, and what we are assuming that my underlying is in a bullish trend. Okay, so we are expecting it's gonna go up. And volatility wise, so we are assuming that volatility is very high or high. Okay, so we want a volatility to be very high and high, then we will go for a bull put spread. Expiry wise, we want near expiries because this is a credit strategy, so near would be much better. But if you think that you're not comfortable with the near, then go for the next series. Okay, and the spot level, as this is a directional strategy and it is a bullish directional strategy, so we want a spot level to be preferably at our support level, or maybe at the resistance breakout level, where you're thinking that the current resistance would become a support in the future. So in that case, you can go for bull put spread. So first outlook is bullish. We want a volatility to be high and very high or high. Expiry was all at the near would be much better, and the spot price we want to be at the support level. Okay, and let's see the beauty of this strategy. When market goes down and it comes sharply to your support level, so most of the time you're going to see that the underlying volatility would be much higher. So this is a much preferred strategy. So let's see the structure of a bull put spread. So in this case, the main portion would be the short position. That would be a short ATM put or OTM put. And then we need to add an insurance because we are taking a bullish strategy and we are shorted a put. If market goes drastically against us, instead of going bullish, it goes bearish, then we need a protection. And here protection would be our long OTM put or maybe a deep OTM put. So structure is minus P means main source of income and plus P means a long position. That would be our stop loss kind of a position. Okay, so here if you see the payoff, if market goes bullish we will be in the profit, and if market goes bearish it would be in loss. And then you do have a lower break even or production levels are over there. So we want market to go up as fast as possible, and if market goes against us, then we are happy to book the loss. Now in the next slide we're going to see the example here. So we are assuming that market is currently at 70,500, and we are assuming that outlook is bullish, and we are expecting the market to reach around 18,000. Okay, so your outlook is kind of a bullish. Okay, and then we will, and the volatility is very high, so we are saying let's start a bull put spread. So in this case I'll go short position 70,500. That's my ATM strike. So at the ATM strike I'm happy to short. Okay, and then maybe a one strike below at 70,400 I'm happy to buy the insurance. So if you see to net credit what we have received is a small one, not much a bigger one over here. That's around 37. So 37 is a max credit that we have received in this strategy, a max profit potential, versus the worst case loss. If you see in this strategy, 37 minus the spread difference. So spread difference is 100 here. I mean total spread difference between the short position and the long position. So that's 100 points. So 37 minus 100, that gives you around 62. Okay, or 62 point some odd numbers are there. So that's your maximum loss in this trade. Okay, now to calculate the break-even points here, so just remember the number, the maximum profit potential, the credit that you got 37. So go with the main source of income, that's 70,500 and minus 37. So that would be a 17,462. That is what your lower protection in the strategy, and this is your payoff diagram. So you can see that's our lower protection. A maximum profit potential would be anything above 70,500, and then worst case loss anything below 70,400. Now let's talk about here a Greek impact. So we can see that total delta is here kind of positive. So if my underline goes up, we will have a positive impact, and if underline goes down, we will have the negative impact. So here we want market or maybe underline to go up. Vega wise, we can say negative because this is a selling strategy. We have already sold. If volatility increases further, for whatever reason, that would have a negative impact on us. So we will take this strategy when vols are very high, so that there would be some scope to reduce. Theta wise, it's showing us here kind of a negative theta, but if you go with the right strikes, most of the time you will get a positive theta. Okay, so it's showing us kind of a negative, so we just gonna ignore over here, and gamma we're gonna ignore here. Okay, so most of time in the bull put spread, because that's the kind of a credit strategy, we get a positive theta. Okay, so with that, we have completed our bull call spreads and bull put spreads. So next video, we will talk about the bearish strategies. So the focus would be a bear call spread and bear put spread. So see you in the next video. Welcome back everyone, and this time we're gonna start into the world of vertical spreads. Okay, so we will talk about bull call spread, that is our first vertical spread. As the name says, bull call spread. Okay, bull means what? Bullish strategies, and call spread means there would be two calls, one short call and one long call would be there. As the name says, bullish call spread. Okay, so it is a bullish strategy. So once again I'm repeating, and there would be a call spread, and this is a debit strategy. Okay, just note down, this is what a debit strategy. So we are going a long call, which is slightly expensive, and then we're shorting out of the money call, that is a cheaper one. Okay, so net we are a buyer here, so that's the reason this is a debit strategy. Again, all the strikes, all the positions are of the same series. Okay, so we're not shifting series to series here. So here, preferably if you want to initiate a trade, go for a long at the money call, or maybe slightly in the money call would be okay, and then out of the money call you need to short that. Okay, this is a vertical spread, and with the same ratios, it means we are going to go one long and then one short. Okay, so it's a balanced strategy. It means my risk and reward both are limited. Okay, so now we're going to see what are the prerequisite for bull call spread. Okay, so first outlook wise, so we want market to go bullish. Okay, so we want something like bullish outlook. Okay, next comes volatility. So we want a low volatility, because net we are a buy here. It's a debit strategy, so we don't want volatility to be very high here. Okay, expiry wise, we would prefer to go for the far series, but if there is a liquidity issue, come down to the next series, and if there are more than 3 weeks are there, then you may go for the current near series. Okay, spot price wise, when to initiate this trade, so we want price to be at support. Okay, or maybe at a resistance breakout. Okay, so those will be two things. So we want price to come down to our support level, and then we're going to initiate this trade. Our market went to the earlier resistance, and there is a breakout with the good volumes of some other conditions where you are sure that the earlier resistance would become a new support, then go ahead and take a bull call spread. Now here, let's see the structure. Okay, so in this trade we have a long position, and that is a main source of income, so that has to be either at the money or in the money would be a preferred thing, and insurance would be out of the money, that would be a cheaper one. So we are buying something which is expensive, and we are selling something which is much cheaper. So that's the reason this is a net a buyer strategy or a debit strategy here. Now, if you see the payoff, if market goes bullish, we would be in profit, and if market goes bearish, we would have a limited loss here. So I'm happy to lose maybe potentially 1 rupee to earn maybe 2 or 3 rupees. And that is what our aim in this strategy. So if volatility is very low, the pictorial diagram would be much better. But if volatility is high, then you may not get a really good pictorial diagram over here. And this is your upper break-evens, or you may call it upper protections. Okay, and that's your T plus 0 line, as you can see in this slide. Now let's take the example here. So assume that market is currently trading at 70,500, and I'm assuming that market may go before the expiry, or maybe at the expiry it will reach 18,000. Okay, so we're expecting around 500 move from the current level. In that case, we would go and a long 70,500 call, and that would be expensive one. Here in the example, you can see the price is around 324. So if you're going only with the long position, the net debit would be 324, but we want to reduce that a debit, and that's the reason we're going a short, and we are shorting out of the money our target. Okay, so here we are shorting 18,000 call at price of around $100. So in that case, total net your debit has reduced. So 341 324 minus 100, and that would be around 224 level. So if you see, the maximum that loss would be in this trade would be 223, versus if you see the max profit potential in this strategy is the strike difference. So total strike difference is 500 minus this debit, and that would be 276. So 276 is the maximum profit potential, versus worst case loss in this strategy is 223. Here it may not look too lucrative, because the price is shown based on when the volatility was very high. Had it be volatility very low, this would have shown a really good profit percentage ratio, versus profit versus a risk ratio here. Okay. The example we took is on Feb 2nd, and that time were very high, and that's the reason that time this is not advisable to initiate a long strategies, okay, or debit strategies. Now let's see how do we calculate a upper break even. So the net debit that we have paid is 223. Okay, so what you have to do, you have to go with the long strike and long position, because that's our main source of income. In that case, add the net debit. Okay, that will give you break even. So that was 70,500 plus 223, so that would be 17,723. So that would become your upper protection, or maybe a break evens, you may call it. Okay, let's see a payoff diagram with this example. So if market moves up bullish, that would we would end in the profit. If market goes against that, then that would give us a loss. Okay, and the T plus 0 line, if there is a market sharply moves in next 2 or 3 days, we would have immediately really good profit. Otherwise, the more you stay in the trade, you will have a theta impact, and that would impact you negatively. Now next question comes Greek impact. Okay, so let's start with the delta. So here we can see delta is positive 0.26. It means every 1 rupee move in the underline, you're going to earn around 0.26 as of now. So it means we want market to move positively. Much faster pace would be much better for us. Okay, so that's the reason delta is much higher here. And total Vega, it is showing us a 3.51. That's again a positive number. So if my Vega increases, if the volatility increases, that will be good for this trade. So both delta and Vega is supporting us if it increases. Okay, so we want delta to increase, we want underlying price to move up, and we want a volatility to increase further. So that would be good for us. The only component that would be a negative would be a theta. So the longer you hold this trade, that would be a much problematic. But remember here, as we have shorted or something out of the money, our theta is not that bad. It's just around minus 2.3. Okay, had you not shorted that, then theta would have been much higher. Okay, so here when you took this bull call spread, we want underlying to move up. We are assuming that volatility will increase further. If this both supports you, the profit would come much faster. Otherwise, there would be a delay in getting the same profit potential. And gamma are currently showing us a 0. So that is all about our bull call spread. So guys, this is again one of the best strategies, especially if your volatility is low, and whenever you trade vertical spreads, it gives some added advantage because here you can add some delta component versus if you're only trading a non-direction strategy. So we remove the delta and our aim is to earn from vega and theta. So sometimes you have to mix up both the things. So guys, see you in the next video where I'm going to talk about bull put spread. Okay, folks, we're gonna start a buy strategy here, and we're gonna start with a buy call spread. Okay, so this is a buy strategy, as the name suggests, buy call spread, and there would be a call spread. It means there would be some short call and the long call would be there. So something short and something long, it means it's a vertical spread. So this is a credit spread, this is a vertical spreads, and of course this is a buy call spread. All the legs or positions in this strategy would be of the same series. So the main source of income is here short position. So short ATM calls, or the first OTM call, I would say, short it, and then you go long OTM or maybe deep OTM call. So that is what we are doing. So we're going to short a call and we go further a slight higher strike, and we're going to buy the insurance, and we are assuming market to go down. As this is a balanced strategy, it means my risk and my reward both are limited. Okay, so this is a bearish strategy. So market is supposed to go down, we have shorted a call and we went for the higher strikes and we bought the insurance, so that if market goes down, that's good, but if market goes against us, that insurance will protect us. Preconditions for this strategy: first of all, your outlook is that market, our underlying is gonna go down. Okay, so that is our first condition, that our outlook is maybe a kind of a sideways to bearish. That would be you can call it a much better condition. And then volatility is currently a very high or high. So we are assuming that the premiums in the markets or the option premiums are very expensive. It is a very expensive or just expensive. Expiry would be a near series would be much better, but even next would work over there. And spot price would be preferably at the resistance. So let the price be our resistance, and we are assuming from there it's going to fall down. Okay, so let me repeat once again. Outlook is bearish. Walls wise, we want very high or high. Expiry wise would be a near much preferred, and the spot price wise we want to be at the resistance or maybe at a support breakout. Okay, so that will be much a preferred kind of things. Okay, so what happened, market already went down, it went to our earlier support level and just breaking that. So by the time it went down, walls would technically increase, it would be very high, and now again it's breaking our the support, and we are assuming it's going to go further down. So if you see, that would be most ideal situation, versus if prices goes up and touches our resistance, that's another condition. But most of the time what happens, walls are low there, so that's not a really ideal situation to take this trade. Now let's talk about in terms of positions or the structure wise. Okay, so the we are saying market to fall down. So we did a shorted OTM ATM calls, or maybe a first OTM call we have shorted. So that is our main source of income. So that will be a premium that will be in the short position. That will be our max profit potential, and plus minus your debit for the insurance. So a few strikes above, we're going to buy the insurance, and that would be a debit. So net if you combine both, it will be a credit strategy. So short call is a main source of income, and long call is my insurance to protect from our delta losses. Now let's see the payoff diagram here. As you can see, if market goes bearish, we would be in a profit, but if market goes bullish, we would be in loss, and that's our upper protection over there. Note down T+0 line and note down your expiry day line. So if market goes bearish and it goes slowly also, that will be much beneficial here, because we would earn from even theta and maybe from vega also. And but if market goes against our direction, so instead of market going bearish, if it goes bullish, then this would end in loss. Now let's see an example here. So we are assuming that market is currently at 70,500, and we are assuming that market may stay at 70,500 or may fall down further. But here the thing is that I'm not assuming market to go up. Okay, So in that case, I'm going to short a 70,500 call. And in case if market goes against up, we need insurance. So we'll go and buy maybe 70,600 a call. So here my condition is that market may remain sideways or may fall down. So in that condition, we are going for bear call spread. Plus Wall's volatility is very high. So that will be a really good ideal situation to initiate this trade. Now, if you see the price what we have paid in the example, so for the short call we are paying, we are receiving around 324 because that is what a credit we're gonna receive. Versus a long call we're gonna pay around 265. So currently showing really very heavy premiums over there. But if you subtract a short call minus a long call, then the maximum profit potential is 58 points. So here, if you subtract 324 minus 265, so it's showing us roughly 58 points maximum profit potential in this strategy. That is what a net credit you have received. Versus if you say the losses, so just remember credit. So we have received around 58.15 credit. And what is the spread difference? So spread is 70,600 minus 70,500. So difference is 100 points. So subtract 100 minus 58 the credit what you have received. So that would be around 42. So that is the worst case loss in this strategy. Okay, so maximum you can lose around 41.85, and the max profit portion you can earn is 58 points. So this now let's calculate the break evens. For the break evens, you have to remember here a credit. So how much credit we have got? 58 points. So remember 58 points and remember your short call because that's the main source of income. So 70,500 plus a credit, that is a 58 points, and that comes to 70,558. So this is your upper protection, or you may call it a break evens for this buy call spread. Let's see payoff considering this conditions. So our payoff looks something like that. So if market goes bearish, we will be in profit. Versus if market goes bullish, I'll be in loss. Okay, and if it goes down and stays there for a longer duration, our profit potential will increase because of more theta being into the trade. Okay. Now, if you see a Greek behavior, so delta is showing us negative. It means if price increases, that will be we're gonna lose. Okay, so we don't want price to increase versus we want price to reduce here. That's the reason showing us negative delta here. So we don't want price to increase versus we want a price to decrease here. Okay, and Vega wise you can see it's negative. It means we don't want Vega to rise further. Vega is already very high and we are shorting so that it can go down. So if it goes up, then that will have a negative impact. So we're going to take this strategy only when volatility is high or very high. Okay. Now in terms of a theta showing us green because this is a net selling strategy. So it's showing us a green theta, positive theta. And so the more you spend a time in this trade, and the direction is in your favor, then you're gonna earn from the theta much faster. Okay, gamma wise current is showing us a null. Okay, so that is all about your bear call spread. And in the next strategy, we're gonna take our last bear strategy, and that will be a bear put spread. So see you there, guys. So welcome back guys here, and this time we're going to start another bearish strategy, and that is bear put spread. The name says bear, it means it's a bearish, and it says put spread, it means we are doing some vertical puts here. Okay, so basically we are shorting some puts and then we are buying some put over here. So this is if you see different names for this strategy, first of course it's a bear put spread. We may call it a vertical spread also. We may call it a debit spread also. At the same time, you may even call it is a vertical debit spread. All the positions or legs are of the same series. Okay, so here we're going at the money or maybe slightly in the money, a long put, and we are going out of the money. That would be possibly our target strike, and that will be a put. Okay, so it's a balance strategy. It means we are shorting the same ratio of a put equal to the longs put. So it's a balance strategy. So my risk and reward both would be limited. Okay. So folks, let's talk about the prerequisite for bear put spread. Okay. So the first and the foremost important is outlook. So here we are considering a bearish outlook. and the volatility we want to be low because this is a debit strategy and we want to pay a low premium. Expiry wise, we would prefer to go for as long as possible, so we would go for either a far expiries or the next expiry. But if in the market, if we don't get enough liquidity, then you are forced to go for the near series. In that, I would say look for maybe at least 3 weeks are there for the expiry. And the spot price wise, we want our underlying price should be at a resistance so that it will just go one way down. So that is what a prerequisite for our bull put, a bear put spread. So that is a prerequisite for bear put spread. Next thing, structure wise. So in this strategy, we know there are two positions are there. One is a long ATM or maybe slightly in the money put, and then we have a short OTM put. Okay, and market is somewhere here and it's going to go this way down. So this would be main source of income. The long is main source of income versus the short position is a insurance, and this insurance is mostly for a theta because long positions, if you say in the trade theta gonna have a negative impact. To compensate that negative impact, we have a insurance and that will compensate a bit of it. Okay, so this is the structure for our bear put spread. Now let's see the payoff diagram. So as you can see here, if market goes bearish, we would be in the profit. If market goes bullish, we would be in loss. I'm happy to book maybe a small loss so that I can have a 2 or 3 times maximum profit potential is there. And this would be a break even that is over there. And do note T plus 0 line. So bold line is here expiry payoff, and versus a dotted line is for T plus 0 payoff. Now let's take the example. So here we are assuming that underline is at around 70,500, and we are assuming that it's going to fall down to 17,000. Okay, so this is underlying price and it's going to fall down. Currently the volatility is very low or maybe low, and the price is at around 17,500, which is our resistance level. Okay, so we will go long put 70,500 and we're going to short a target of 70,000 put. Okay, so this would be our bear put spread. So let's see in terms of a price. Okay, so in this particular example, we went for a long put for 225. Okay, and then we went for the a short put, that is 87 rupees some 60 paisa. Okay, so if you see what is total debit here, so you have to say 225.10 minus 87.60, and that is 137.50. So this is a maximum debit in this strategy. So that is your worst case loss in this strategy. Versus if you see what is the maximum profit potential, so you have to find out what is the spread between a short put and the long put. Okay, so if you subtract this a long put minus a short put strikes, that would be 500 points. 500 points minus your debit. So debit is 137.50. So if you subtract 500 to this number, that would give you 362.50. So that is your maximum profit potential in this strategy. Okay, now let's talk about our break evens. Okay, so break evens, you have to consider debit here. So our debit is 137.50. So what you have to do, you have to go and see your main source strike, that is 70,500 minus 137.50, and that would give you 17,362.50. So this is your lower break even in this strategy. Okay, so now let's see if we assume this scenario, what will be our payoff. Okay, so this is our payoff. So in case if market goes down, we would be in a profit. If market goes up against us, then we would be happy to book our losses. Okay, now in terms of Greeks, what's the behavior? So if you see a delta, it is showing negative. Okay, it means if price goes up, then we will have negative delta. So we want price actually to go down so that we will have a positive impact of delta. So this is a bearish strategy. We want underlying to go down. Now let's talk in terms of volatility or Vega. So here you can see that if there's a 1% increase in Vega, we're going to earn around 4.33 extra points. So we want Vega to rise as early as possible. So we want Vega to rise. It means Vega should be low as of now. Okay, so initially, while initiating the trade, we want Vega to be low, but once we are into the trade, we wish that Vega should increase, maybe from a low to go to neutral level, or maybe to the high level, or maybe to the very high level. Okay, theta wise, you can see that's 0.59, but it is in the red color, it's in negative theta. So more you stay in the trade, you're going to lose some bit of a value. But here we are losing very small value. Can you guess why we are losing this small value? It is minus 0.59 because we went for the long, but at the same time we went for the short also. Okay, so long will have some higher theta, but short is compensating that, and that's the reason there is a minute impact as of now. But as you go close to the expiry, this value would increase further. Okay, and gamma definitely would have a positive impact because this is a debit strategy. And but to see the actual impact of a gamma, you have to wait until the expiry. But we avoid taking this trade all the way to the expiry. Okay. Yeah. So this is all about our bear push spread. Hello everyone, this is Santosh here, and today we're gonna cover derivative hedging strategies. So let's go and let's start with the strategies. And today our first strategy is covered call. Believe me, this is one of the best strategies I do love. Okay, doing a covered call. So in case of the covered call, what we do, we need to have an underline in our portfolio. So assume that you have some stocks in your portfolio, and that is roughly minimum should be around one lot quantities. So if you have a one lot quantity of the stocks in your portfolio, then you can go and deploy a covered call. So in case of covered call, what happens? We go and short out of the money calls. So the main aim with the covered call is to generate a rental income. Okay, so that is a thing. So here my possible outlook is sideways to a moderate bullish kind of things. I don't want underline to go super bullish. If super bullish, it is going super bullish, then the short call that what we are shorting would create a problem for us. So your outlook for your portfolio should be a sideways to moderate. So here we're going to have a long call. Here we're going to have a long stock that is underlying plus a short call. So that is what a covered call it means. The call that we're going to short would be out of the money call. So let's see what are the prerequisites. So first, the most ultimate requirement is that we should have the underlying, and then we will go and short out of the money call with our outlook for the underlying is that it would be a moderate to, it would be sideways to slightly bullish kind of thing. Volatility wise, there is not a major concern, but as we are shorting out of the money call, if volatility is high, then that's gonna benefit us. For the series that we have to select, I would prefer to go for something like a near series, and if near series is too near, then we will go for the next series. So let's see the positions. So definitely it's going to have a two positions. So one is a long stock that is in your portfolio. A few guys I have seen that instead of going for long stock, they prefer to go a long future. So even that is okay. But the classical way is to just go for a long stock plus a short out of the money call. So as you can see on the screen, that's our example here. So we will go assume that a Nifty as a stock going long, or you can go a Nifty future long plus some out of the money call short. Payoff wise, as you see here, so if underline goes up, that will be beneficial for us. And if underline goes down, in case your losses would be less compared to if you go without a naked, without a short call. Okay. So in case if underline goes down and you're not doing a short call or you're not doing the covered call, then losses will be slightly higher versus in this case your losses will be less. Okay. And then if market goes all the way to the short call strike, then that will be beneficial for us. Our underlying portfolio will increase as well as a short call we're gonna gain. Plus, if underline goes super bullish kind of thing, in that case we would end in the green, but we're gonna lose some opportunity to gain more. Now here is the example. So we are assuming a Nifty as a stock, okay. Although that's not practical, but just for the sake of the example, Nifty assume as a stock, and it is currently trading say at around 17,500. In that case, we are assuming that by the end of this series, would maximum it can go 18,000. In that case, we're gonna long stock 70,500, and then we're gonna short call at 18,000. It may happen that you are holding a stocks earlier. No need to worry. Just see the current spot price, and then based on the spot price, you have to say that this would be a possible target for the series. So there we go, and we short out of the money call. And that's your payoff diagram. So in the payoff diagram, you can see that if market goes up, you would be in profit from both underline plus short call. And but if it goes super bullish, then we would be benefit from we get benefit only from the underline, but short call may give some minor losses. But overall, if you see a portfolio, you would be in green. Now let's say something about summary of the stock. So you're going to see that if my underline goes all the way to 18,000, in that case, we would have a maximum profit potential. So just assume here we are going underlines 70,500 as a long. Typically, our profit without the short call should have been around 500 points. But here you can see that our profit is 752 points because we have shorted a call, and that short call is also helping us. Worst case loss, that is what it can go up to the zero. So that is ideally should be 70,500, but our losses are less because we are getting benefit of a short call. Okay, so that's the reason here the losses are showing us a 17,247 because that's the difference of what a short call price. So our losses are less. Okay. Now, if you see a lower production, that's a break-even point. So that would be 17,500 minus your long short call strike. So that would be a low production is here 17,247. So that is your underlying price. Minus your short call price. So underlying price was around 17,500 minus your short call price. If you see data wise, it's showing us that it's a positive data, that is 0.65 in this particular example. It means if my underline goes up every one unit, we're gonna get 0.65 points in our pocket. So that is what's showing us. Vega wise, it's showing us negative. So if volatility increases, that's gonna hurt us. So we want to take this strategy preferably when volatility is very high. In that case, short call are gonna benefit us more. Okay, and theta wise is showing us a positive theta because we are shorting out of the money call, and the more we stay in the trade, we're gonna get benefit of theta. So that is what overall short call, that is a covered call summary. And let's see what are the possible outlooks. Okay, because a lot of time I have seen that a lot of guys do a covered call, but then they get hesitate to see what is the typical outcomes. So there are possible four outcomes in case of a covered call. One is let's assume that your underline stays as the same level. So you went long underline at 70,500, you shorted a call of 18,000, and underlying stays at 70,500 itself at the expiry. Okay, in that case, it's gonna benefit us because the short call 18,000, whatever premium we have shorted, that will be ours. Okay, so that will be a positive for us. Now let's see if underline goes down. Okay, so underline goes down by say 1% or 2%, or maybe underline goes by 300 points. Let's take the example. In that case, if you would have not gone with the covered call, your losses would be 300 points versus in this case, your losses would be less because short call premium would benefit us. So it will be whatever point it goes down versus subtract your short call premium. So your losses will be slightly less. Now let's say if underline goes moderately up. Okay, it goes maybe in between 70,500 to 18,000, what the strike that we have shorted. If it goes anywhere in between or at 18,000, in that case our profit will be much higher because we're going to earn from the portfolio positiveness. At the same time, we're going to earn from a short call. Versus assume that underline goes super bullish. Okay, so instead of going 80,000, it went all the way to 82,500. In that case, we're going to miss some opportunity. But if you see, our portfolio would be green because we have again almost 500 points plus whatever short call premiums were there, that would come to us. So net wise, if you say, your portfolio would be green. So that is what benefit of going for a covered call, and this is what is in case if your portfolio, definitely attempt a covered call strategy. So that's chapter 1, that is covered call. See you in the next chapter. Welcome back everyone, and today we're gonna talk about covered put. Okay, so this is covered put is similar to covered call, but just inverse. Okay, so what happens in case of a covered call? We are holding the stock and then we're shorting out of the money call. So in case of a covered put, we are shorting the stock and then we are shorting out of the money put. So if you talk about the Indian market, then overnight shortings are typically not allowed. So in that case, for us, the option is short of future and then short out of the money put. Okay. So here, this is a typically a credit strategy. If you consider shorting out of the money put, and our outlook is sideways to moderately bearish. Okay, so we are assuming that underlying would go down, but not super bearish. And in this case, we're going to have a two positions. So one be a short stock or short of future, and then short out of the money put. And if you see profile wise, risk in this strategy is unlimited because we have shorted a put and underline can go up infinite. Okay. And then in terms of reward, it is a limited one as we have shorted a put. Okay. Now let's see what are the prerequisite for a covered put. In that case, as I told you, the outlook is a sideways to moderately bearish. That is what our outlook. In terms of volatility, that is not a main criteria for us. But if the volatility is very high, that's going to benefit more because we are shorting out of the money put. Okay. And in terms of expiry, I would say go for the near series. That's much better. But if near series is very near and if you're not uncomfortable, then you may opt for the next series. Just make sure that there is enough liquidity. Okay. Now let's see what are the typical positions in this strategy. So we're going to have two positions. As I told you, one is a short stock and then short out of the money put. If a short stock is not allowed, in that case you can opt for the short future and with a short out of the money put. Okay. Let's in terms of payoff, here you can see that dotted line is a payoff for T or T plus the days what you write, and the bold line is for the expiry. So we're going to have two position as you can see here. One is a short stock, so the diagram goes like this. So if market goes down, that's good for us, and if it goes up, then that's gonna hit us. Okay. Now let's take the example here. So in this particular example, we are assuming that underline is nifty and we are allowed to do short stop. If not possible, you can go and very well do a short future. So we are shorting nifty at 17,502 and some odd points, 30 points, and we are shorting 17,000 put, that is out of the money, and that is at around 167.90 points. That is what as you can see in the screenshot. And if you see maximum profit potential, that is 670. Now you wonder how the 670 came. So here our underline is at 70,502, and so that's a 70,500, and overall the premium is 167.90. So if you combine 500 strike and 167, so that's giving us a 670. Okay, and just remember here, short put is 70,000. So distance between the underline and OTM put is 500 points. So that is 500 points plus short put premium, that is around 167. So if you combine, that is around 670 points is what a maximum profit potential in this strategy. Now let's talk about the upper protection. So upper protection means wherever we are shorted, and then we need to add a premium for the short put. Okay, so we are shorted at 17,502 plus the premium 167.90. So if you add both, that would come around 17,670, and that is what your upper protection. Okay, so this is the way to calculate your maximum profit potential and the upper protection. And let's talk about the payoff. So if underline goes moderately bearish, that's good for us. If it goes super bearish, still that's good for us because we would end in the profit. But if it goes bullish, that would gonna hurt us, but our losses would be less compared to the other guys who did a naked short underline. Okay. Now let's talk about the summary, especially the Greeks part. So here you can see that our total data is negative. Negative means what? We want underline to go down. So if underline goes down by 1 unit, we're going to earn 0.72 as is shown here. So we want underline to go down as our outlook is sideways to bearish. In terms of Vega, we can see it's written negative. So if Vega increases by 1%, it's going to hurt us by 18 points. Versus if volatility reduces by 1%, we're going to gain 18 points. So here we want volatility to be high when we initiate this trade, and then we want volatility to go down, to calm down. So that's going to benefit us. In terms of theta, you can see here that it is a green color, so it means it's gonna benefit us. The more we stay in the trade, it's gonna benefit more because of a short put. Okay, so let's talk about what are the possible four outcomes. Okay, so in this particular strategy, that is covered call, if underlying stays at the same level, we will not benefit from the underlying, but short put gonna benefit us. So overall, your portfolio would be better. Now, if it underline goes up, we would end in a loss, okay? But our losses would be less compared to the other guys without a covered put, okay? Now, if underline goes down moderately, in that case, that would be a double dhamal for us. In that case, we're gonna earn from shorting up underline, at the same time from shorting a put. Versus if underline goes super bearish, in that case, we're gonna earn from shorting a put, but there would be some losses from a short put. But if you consider overall portfolio, that would be in green because we have earned 500 points in our early examples, and then up below the 500 points, we won't be able to earn anything. Okay, but still our portfolio would be green. So in all the four scenarios, we can see that it's going to benefit us. So in the three scenarios, it's going to be a positive benefit, and in the last scenario, it will be a losses but slightly less a loss in case the underline goes up. So this is all about the covered call, and see you folks in the next topic. Thank you. So welcome back everyone, and today's chapter is to go through one of the most important topic, and that is a protective put. As the name says, protective means protection, so it's going to protect your portfolio. So assume that you have some stocks. In that case, you can go and add a long put to that, so that in case of a big events, you want to add some protection. It's going to give you some protection. So there are two things are there. One is a long underline and then long put. Okay, so in this case, if you see a profile of this strategy, reward wise it will be unlimited because underline can go up as possible, infinite, and protection on the lower side would be from the long put. So my risk in the trade would be limited. And if you see the pay of this protective put, it would be similar to long call, and that's the reason this is also known as a synthetic long call. Okay, so let's talk about the prerequisite for protective put. As I told you, the outlook wise, it's a bullish outlook. That's the reason we are holding the stock. So our outlook is bullish. But if you are uncertain that there is, it may crash for some reason, then we do add up a long put. Okay. So typically outlook is bullish. And in terms of volatility, it's not a main criteria, but as we are buying the put, long put, okay, so we need to pay some premiums. So lower the volatility is much better. So we want premium should be lower, okay. Next, in terms of expiry, the fast series are much better, but unfortunately, like Indian market, we don't have enough liquidity for the stocks. So either we have to settle with the next series or the near series. So in the stock option, I would say the near series are much feasible for us. And but if you're close to the expiry, then go for the next series. And if you're doing this protective put with the Nifty base, in that case, I would say go and buy the December and series. Okay, so the premiums that you're going to pay would be much lower compared to the monthly long puts. Okay. Now let's see what are the positions. So there are two positions are here. One is underlying, so that would be either you can use the stock or you can use the future. That's both okay. And then we would gonna add insurance, and our insurance is a long OTM put or maybe a near ATM put. That is also okay. So structure wise is a long put, long stocks plus long put, as in the example is given here. Okay. Now let's see what is the typical payoff. The typical payoff similar to your long call. So if I don't write this is the strikes, then you would be confused whether this is a long call or your protective put. So here you can see the break even line that's over here, and then we can see that we have a long put and then we have a long stop. Okay, so it is similar to a long call. So we have unlimited profit on the higher side, and on the lower side if market goes down, then we have a limited loss in this strategy. Now let's take the example. In this example, we have a stock. For example, like just take example here, Nifty. So that's our stock, and that is currently being traded at 70,500. Let's assume that, and then we're gonna add a long put. So here I'm happy to lose 200 points. Okay, so roughly we took long put over 70,300, and the premium for that is 225. Okay, so if you see a maximum profit potential in this strategy is unlimited, because if my underline goes up, so I'm gonna get more benefit from this, versus if you see maximum loss risk in this strategy, it is showing us a 14 to 5. Now the question would come, how does this 14 to 5 came here? So in that case, you have to subtract underlying price and long put strike. So that would be around 200 points. And then we had paid a premium of 225. So 200 plus 225, that would be 425. So that is what maximum you're going to lose in this strategy. And let's talk about the upper break even. So there would be some break even because we are buying here. So the break even is showing us a 17,725. So that's a 17,500 is a underlying price, uh, plus a premium. So premium is 225. So if you sum up both, that would come 17,725. Okay, so that is what the calculation for maximum profit potential and the worst case a loss in this strategy. Now let's see a payoff here. So that is what payoff. So you can see the dotted line is for today, and the bold line is for the expiry. So we went a long stock at 70,500, and then we have added a long put of 70,300. So this is a payoff for your protective put. Okay. Now let's talk about the summary specifically for the Greeks. So you can see delta should be a positive here because the underlying goes up, it's gonna benefit us. Versus if you see Vega, that is also good for us. So we want a Vega to rise. So Vega would rise only if the current level of Vega is low. So we have to take this position when volatility is low, so that we are paying a less premium, and as the volatility increases, that's gonna benefit us. Okay, in terms of a theta, if you see total theta, that is negative. Now question is why negative? Because we went for a long put, and long put would have a negative theta. The more you hold this trade, theta gonna impact us negatively. But the here thing is that we are holding the trade because we want a protection from uncertain kind of a bearish structure. Okay, and that is all about our protective put. This is one of the best strategies being used specifically on bigger events, specifically like general elections, central bank announcements, budget, those kind of things are there, where you have a portfolio and you want to protect your portfolio. So just go ahead and see if you can deploy a protective put to your portfolio. For me, specifically with the Nifty Bs, I occasionally do this one in case of big events, just to safeguard myself. So this is the best strategy. I would recommend everyone to use protective put. And that's all for this chapter, and see you in the next chapter where we're going to talk about collar strategy. Thank you. So welcome back once again, everyone. And today we're gonna talk about collar. Okay, that's what collar strategy. Okay, so collar strategy, if you see, it's a combination of a covered call that we have seen earlier, and then we did a protective put. So if you add both the strategies, that ends with a collar strategy. So what happens in the collar strategy? We do have a long underline that is there, then we short out of the money call. So long underline plus short out of the money call, that means what? Covered call. So that is done. And then we go and add a insurance on the lower side. Okay, and that is what? Long put. So as I told you, it's a combo of a covered call plus protective put. If you combine both, that becomes what? Your collar strategy. So here our outlook is bullish. but not kind of a super bullish. Okay. So as in this particular strategy, it's we have a short call on the outer side, plus we have a long put on the lower side. So in terms of reward, it is limited because of the short call, and in case of risk, again limited because of the long put in this strategy. Okay. And let's see what are the prerequisite for this. So our outlook is like kind of a bullish, but not super bullish. Okay, that is the thing. Volatility wise, not a big consideration here, because whatever short call we do, we're gonna get some kind of a benefit of volatility, but that will be wiped off because of this long put. So major impact, there is no major impact of volatility in case of a collar strategy. Versus expiry wise, I would say preferably go for a near series or the next series. Okay. Now let's see what are the positions. So we're going to have a three positions in this strategy. So our the main source of income is underlying. So that is what long stocks or long future, and then we're going to have insurance. Okay. So one insurance is on the upper side short call, that is to get some benefit of theta. Okay. So that's a short OTM call. And then on the lower side, we will have actual insurance, and that would be a long put. So if my underlying goes down for whatever reasons, we need to have a limited loss. Okay, so that is what long OTM put. Okay, so both the positions are OTMs. So OTM short call and OTM long put. So typically three positions are there. One is a long stock, and then long put, and then we have a short call. Okay, so those are the three positions. As you can see in the screenshot, the one in the white colors are the long positions, and one with the background red is what your short position here. Okay, this is a typical diagram here. So if you see, our reward is tapped up, okay, it's restricted, and our risk is also restricted. So this is a beauty of this strategy, that there is no surprises on the upper side and on the lower side. The dotted line in this diagram is T plus 0, and the bold line is for the expiry. You can see the stock, the diagram would be this way, short call would be this one on the upper side, and the long put is on the lower side. Now let's see the example here. Okay, so example, we are assuming that Nifty is currently trading at around 70,502. So that is what we are assuming, that it can go all the way to 18,000. So in that case, I'll go and shorter 18,000 call, and then we will go insurance. So I said let's go and add a 500 points below insurance. So that is about 70,000 insurance. Okay. So this is the structure for the our collar strategy here. Okay. Now let's see what is maximum profit potential in this strategy. So it is showing us around that is 584 based on the above calculations and above price. Okay. And if you think of maximum loss risk, that's again limited, and here you can see that is around 415.40. So both are limited, nothing is here unlimited over here. Okay, so this is overall collar strategy. The main function of the collar strategy is that the way the lot of guys use that, they want to buy the protection. So we will go with the protective put. So we will have the underline, and we have added a put. Now they want the cost for this put is too high. Okay, so we want to get some credit for this put using something else. So we're going to short a call. In that case, the insurance of a long put becomes slightly cheaper. So that's the main purpose here. So if you see, the insurance cost is kind of we are not paying too much cost, and we are trying to recover that cost from a short call. So that is what is being done here. Okay, so now let's move on and let's see the payoff diagram. So payoff diagram is something like this here. So the slant line is for your long position, long stock, and then upper horizontal line is for your short call, and the lower horizontal line is for long put. So if market say bullish, that will be beneficial, but if it is super bullish, we won't get much benefit, but then still the portion would be in green. In case market goes down, we will not have a unlimited kind of losses. Our losses would be controlled. Okay, now if you see the summary wise in terms of data, if you see, because this is a bullish strategy, so data is positive. So if my underline goes up, data gonna benefit us. In terms of Vega is showing us negative. Okay, so but don't emphasize much on the Vega, because Vega is being compensated by a short Vega plus we have a long put, so that get kind of nullified each other. Not exactly zero, but yeah, to a certain extent. And theta wise is showing us a positive, but again, don't focus on the theta here. So here our main aim is a delta over here. Now that is all for our collar strategy. Thank you, everyone.